The dump had already happened. By the time most traders opened their apps, XRP was bleeding across every major exchange, red candles stacked on top of each other, liquidations flashing, order books thinning out like oxygen at high altitude. It wasn't a slow bleed, it was surgical. Stops were hunted below key support. Leverage was wiped out in minutes. Funding rates collapsed. Social feeds exploded with the same word, capitulation. But while retail was panicking, I was watching something else. The silence. The kind of silence that only happens when big players step back and let gravity do the work. And then, almost unnoticed, an interview clip started circulating. Not dramatic, not aggressive, just measured comments from Brad Garlinghouse, CEO of Ripple Labs. Most people saw corporate optimism. I saw timing. Because while the market was dumping, on-chain liquidity corridors were lighting up. Payment volume metrics ticked higher. Cross-border rails were active. The public narrative said weakness. The data said transition. That's when it clicked. The dump wasn't the event. It was the distraction. And what happened quietly in the background may be far more important than the red candles everyone is obsessing over. Let me show you what I found. I rewound the sequence of events. There was no catastrophic news, no emergency ruling from the U.S. Securities and Exchange Commission, no exchange delisting, no protocol failure, just vague macro uncertainty and a shift in risk appetite. Yet XRP dropped harder than several comparable assets. That divergence bothered me, because when an asset underperforms without a direct catalyst, it often means positioning was crowded, too many longs, too much leverage, too much confidence. The market needed a reset. And resets don't happen politely, they happen violently. I watched the liquidity pools below major support levels get swept clean. It felt intentional, like someone knew exactly where the pain thresholds were stacked. Retail traders called it manipulation. Institutions would call it efficiency. The announcement wasn't about XRP specifically. It was about creating enough fear to flush the board. And the board was flushed. But what replaced it? That's where things get interesting. Within an hour of the heaviest selling, I noticed something strange. Large transactions began moving off exchanges, not frantic withdrawals, structured transfers, cold storage accumulation patterns, wallet clusters that had been dormant for weeks suddenly activated, not to sell, but to absorb. I tracked one particular cluster that accumulated consistently during the deepest red candles. No hesitation, no emotional timing. That's not panic, that's preparation. Meanwhile, retail order flow showed exhaustion. Sell pressure spiked early, then tapered off sharply. The emotional wave crested, and then it was gone, which means someone had taken the other side. Whales don't guess. They position around expected volatility, and the timing aligned almost perfectly with liquidity conditions easing in broader crypto markets. It wasn't just buying the dip, it was buying the reset, and resets are rarely random. This is where most people stopped looking. But I didn't, because while price was stabilizing, network metrics were shifting. Settlement activity on Ripple's infrastructure ticked upward. Cross-border corridors showed incremental growth. Institutional-facing services didn't slow down. They accelerated. That contradiction matters. If the asset were fundamentally weakening, operational usage would stall. It didn't. Then I revisited the interview clip from Brad Garlinghouse. His tone was calm, controlled, forward-looking. He emphasized liquidity, compliance alignment, and expansion. No defensive posture, no urgency, just quiet confidence. That's when the phrase formed in my head, liquidity switch. Not a literal button, but a strategic shift. Flush speculative leverage, let long-term capital rotate in. Stabilize structure before the next narrative cycle. The CEO didn't pump the market, he signaled durability, and that's far more dangerous for shorts. The headlines focused on the drop, they always do. Volatility gets clicks, stability doesn't. But what they didn't highlight was derivatives positioning after the crash. Open interest dropped sharply, meaning over-leveraged traders were forced out, funding rates normalized, the perpetual market cooled. That's healthy. Painful, but healthy. Institutions prefer clean structure before committing size. They don't build positions into overcrowded euphoria. They wait for silence. And after the dump, silence arrived. No euphoric buying, no dramatic bounce, just steady absorption, the kind that builds a base without drawing attention. This isn't cinematic price action, it's structural rebalancing. And structural shifts are invisible to those who only watch candles. I read the sentiment data. Confidence collapsed faster than price. That's important because emotional capitulation often precedes technical recovery. When traders feel betrayed by the market, they disengage, they reduce exposure, they promise never to trust the asset again. That withdrawal creates space, and markets need space to breathe. I've seen this pattern before in XRP cycles. Narrative peaks, overconfidence builds, leverage stacks, then a sharp correction wipes the board. After that, reconstruction. Retail feels punished, smart money feels patient, and patience usually wins. I started comparing XRP's behavior to broader institutional flows. It wasn't isolated. Risk assets were recalibrating across the board, but XRP's drop was sharper and its stabilization faster. That asymmetry suggests strategic accumulation, not retail optimism, but deliberate rotation. Institutions don't announce entries. They create environments where entry is optimal. Fear lowers resistance, and once resistance weakens, capital flows quietly. This isn't about conspiracy. It's about incentives. Institutions want discounted exposure to assets with regulatory clarity improving over time. Volatility provides that discount. Within days, sentiment began to soften. Not bullish, just less bearish. That's how reversals begin, not with fireworks, with reduced hostility. Commentators shifted from collapse to consolidation. Analysts started discussing long-term positioning again. The emotional edge dulled, and when emotional extremes fade, structural positioning becomes dominant. That's the shift I was waiting for. The market dumped, but the foundation didn't crack. It reset. Here's what I've learned watching XRP for years. Price moves are rarely about what just happened. They're about who was positioned wrong before it happened. By the time the red candle prints, the imbalance has already been building for days, sometimes weeks. Leverage stacks quietly, funding rates creep higher, confidence turns into certainty, and certainty is dangerous in a market built on liquidity extraction. This dump wasn't random, it was mechanical. It punished leverage first. The overextended longs who believed support was unbreakable. The traders who added size because this time is different. The ones who forgot that markets don't move based on belief, they move based on positioning. It punished impatience. Those who needed the breakout now, those who couldn't tolerate consolidation, those who mistook sideways structure for weakness and overcompensated with risk. It punished emotional conviction without structural understanding. But it rewarded discipline, the traders who waited for confirmation instead of chasing momentum, the investors who sized correctly, the ones who understood that volatility is not the enemy, mismanaged exposure is. And here's the warning most people won't accept. If you only react to red candles, you become liquidity for those who understand cycles. Markets are not designed to validate your feelings, they are designed to exploit crowd behavior. When panic spreads, spreads widen. When fear peaks, stops cluster. When everyone sees the same breakdown, the breakdown becomes crowded, and crowded trades are fragile. The real move isn't always the crash. Sometimes it's the quiet stabilization that follows, the slow tightening of price ranges, the decrease in volatility, the subtle shift in funding, the gradual return of spot bids without headlines. That's where foundations are rebuilt. Not in excitement, in silence. Because when volatility drains out and positioning resets, the market becomes structurally healthier. Weak hands are gone, leverage is reduced, emotional noise fades. That's when trends are born, not in chaos, but in calm after chaos. And by the time the breakout becomes obvious, by the time influencers call it inevitable, by the time retail confidence returns, the discount window is already closed. The opportunity wasn't in the green candle, it was in the discipline during the red one.